How are we all going? Good? Okay, let's continue with finance. What I want to do today, I'm actually going to speak a little bit longer than half an hour. I want to pretty much go with finance to lunch, and then after lunch I'm doing property for the rest of the day. Now, with what I want to teach you is really how to become not only number 2, but number 3 level of investing. Now, I can't do it in 2 days. It takes a lot longer because most of it has to do with psychology. People always think, if you just give me those strategies, those secret strategies, I'll go out and I'll make $1 million. I can tell you now, it's the psychology that will make you money. The strategies is only 20% of the equation. You've got to have the 80%. How many people trade actively here, day trade? Yeah, would you agree with that? It's not the mechanics of executing the trade, is it? It's the psychology of sticking, planning the trades and trading your plan, etc. It's doing all that. That's what makes you money. It's the consistency. And with property, you've got to create a system where you're consistently accumulating assets and you have no emotional attachment to it, okay? And that's a very difficult thing to do because to me, it's the consistency outweighs everything else. Because if you can secure one property every 12 to 18 months consistently over 10 years, you're going to do very well. What most people do is they buy the wrong property initially, they get stuck, they don't understand what to do next, and then they buy one property in 5 years' time, and they have problems with that property. So I'm going to teach you how to do it, how to automate it, how to do it in a way that it's systemized, and the end result will be, I'm going to show you how to get income out of these properties so you can stop working. Because that's really what my outcome is. How do I get out of the rat race? How do I stop working and have the option of working or not working? So that's really what today is going to be about. Now, finance is the most important part of that. After lunch, I'm going to spend a bit of time on psychology, and then we're going to get into property. So let's talk about good debt versus bad debt. Now, over the years, I reckon this is the number one reason why people don't invest in property. One of the problems is they don't understand the difference between good debt and bad debt. And your relationship with debt will largely determine your level of success that you'll be able to achieve as a property investor. Now, my parents, being from Eastern Europe, and mind you, the government in Eastern Europe was completely different to what we have in Australia. They were very anti-government, anti-establishment, anti-debt. The more independence you have, the less stress you have in life, the more control you have over life. I can tell you it's the opposite in Western countries, because the more good debt you can secure, the more money you can make. Now, the thing with property is this, and I was speaking to Jamie, I spent 2 days with Jamie at the Gold Coast, who's the owner of 21st Century Academy, and we talked about how quickly he makes a decision to do things, whether it's buying property and commercial property, residential property, and Jamie's a very successful property investor. And we're talking about the fact that wealthy people, and I'm talking about asset wealth, so I'm not talking about that the only way you can actually measure a person's success is through how much money they have behind them, because that's not right. But I'm saying if you're talking about purely money, wealthy individuals, and you might want to write this down because it's such a fundamental rule, wealthy individuals make decisions very quickly and they take a long time to change their mind. Where individuals with no assets behind them take a long time to make a decision and they change their mind very quickly. Okay, and this sounds very simple, but the reason for that is because wealthy individuals know how to conduct unbiased due diligence. So when they see an opportunity, they can sum up the opportunity very quickly. It takes me about 7.5 minutes to do research on the property, and after 7.5 minutes, I can make a decision whether to buy it or not. Okay, that's what I've come down to. Now, for some people, they look at the property, honey, what do you reckon? It's a big. Let's sleep on it. Let's take it. Let's think about it, because they don't even know how to analyze it. Because it doesn't take 2 days to analyze something. Okay, it takes a very short period of time, but it might take you years and years and years to learn the methodology of how to analyze it. Okay, who understands that? It's that simple. So decisions are made quickly, but it just takes a long time to learn the methodology and the system to get to the point where you can make a quick decision. So what you're doing by coming to workshops like this is you're actually condensing time. Rather than you going out and spending 10 years in the market making mistakes and learning the system, I'm going to give it to you all today. So you can very quickly make decisions on properties, and the quicker you can make a decision on buying a property from the open market, the more successful you become, if you know exactly what you're looking for. But your relationship with debt will largely determine your level of success, because at the end of the day, when you're accumulating properties, you're accumulating more debt. Would you agree with that? Because you're always borrowing more money. So on the subconscious level, you have to be very comfortable with debt accumulation. If you've been conditioned by your parents and your colleagues and your culture and your society, whatever it is, that debt is bad, then no matter what will happen in the property market, no matter what part of the cycle we'll be in, whether it's the bottom of the cycle or a growth cycle, you're always going to find a logical reason why it's not the right time to invest. And you're going to justify it. Because remember, human beings are emotional creatures. We make decisions based on emotions, on the subconscious level, and we justify with logic. So if you look at the property cycle, and the property cycle in Australia historically is about a say 8 to 10 year cycle, kind of looks like that. If you've got a very negative relationship with debt, it doesn't matter if you're at the bottom of the cycle, in an upward cycle, or a cycle that the properties are going down or sideways, you're never going to get into the market because there's always going to be stuff in your life, or you're going to have a perception that there's something at the moment that's stopping you from getting in. Whether the properties are overpriced, too cheap, going sideways, etc. But I found over the years that it's not actually that's stopping you from investing. It's because your psychology is wrong about debt. So let's talk about debt accumulation and what debt actually means. The wealthy have a very positive relationship with debt and distinguish between good debt and bad debt. So good debt is basically defined as tax-deductible debt used to purchase or leverage assets which appreciate in value over time. So this means that you buy something and every month or every year it's worth more than you paid for it. And you've borrowed money to do so. That's really good debt. For example, a line of credit used to trade shares, a margin lending facility to buy more shares, interest-only loans used to purchase investment properties. The interest is 100% tax deductible. Bad debts, I say this, is anything with wheels on it. If you can move it, it's bad. It's basically debt that has no tax deductibility advantages, predominantly used to purchase consumables and assets which depreciate in real value. So we're talking about home loans for owner-occupiers. Your home loan is bad debt because it has no tax benefits and it hinders your ability to borrow more money. Now, the most common question that I get asked, which I will answer in about 20 minutes, is, Konrad, should we rent and buy investment properties, or should we buy an owner-occupied property and then buy investment properties? And I'm going to answer that question from two perspectives. Number one, from a purely financial perspective, based on how much does it stop you from borrowing more money or does it help you to borrow money? And then I'm going to answer it from an emotional perspective, because there's two elements to owner-occupied living, isn't there? The ownership element, it's my house. If I want to paint a wall purple, I can do so without ringing anyone, right? And then the other element is it really stopping you from buying more assets or accumulating assets quicker? And that's just pure mathematics. And the beauty of property is that most of these answers you can deduct by doing maths. Most of these things, it's not an opinion, it's just fact. And I'll show you how to analyse these things very, very quickly. Also, things like personal loans to buy consumable assets like cars, holidays, plasma screens, stereos. Anything that you buy that diminishes in value over time. Credit cards are a killer as well, because you're really using those credit cards to buy a lot of different things that depreciate in value or are consumables, and credit card debt actually hinders your ability to borrow more money. Because remember we talked about the DSR ratios yesterday? Absolutely. So this is one of the killers. This is what calls people out of the property market. That's why they can't borrow more money. So if you look at, and this is one of the most important things that I'll show you today, out of all these different asset classes, can anyone tell me which asset class has the highest growth per year in Australia? Anyone? It's actually collectibles. Coins and stamps and art depreciates at the highest amount in Australia, if you know what you're doing. The problem with that is, so why isn't everyone making millions of dollars by accumulating and investing in coins, stamps and paintings? Because there's no leverage. So it's not about the actual growth on the asset, it's the return on equity. And this is what I'll talk about when I talk about structuring your property portfolio. The return on asset is virtually irrelevant. Meaning, I would much rather invest in an asset that's returning 5% per year if I can have 100% leverage than 45% per year if I can have zero leverage. Because it's not the actual return on asset that you're looking for, and I'll show you this in the table in the property section. What you're looking for is how quickly and how much can you control of that particular asset. That's what's going to make you money. And this is the problem with, and I've got a diploma of financial services, financial planning, and it was the biggest waste of time. I mean, I had to do it because I'm constantly just hammering the industry. In fact, I'm doing my advanced diploma of financial planning this year, and then I'm doing my master's. And the only reason I'm doing it is because I hate the financial planning industry. Okay? And ASIC is already telling me to stop talking about different things on stage. So, well, I'm going to go all the way. I mean, I've got a business commerce degree behind me. I don't care. I'll get all the degrees, and then I'm really going to go after the industry. So I'm writing a few articles now that are going to get published, so watch out. But I can't do anything until I've got those letters behind my name. Because then, see, I can talk about the lending industry and how crap it is because I've been in the industry, right? At the highest level. So no one can do anything. But the moment you start challenging an industry and you're not part of the industry, what happens? They come out of the woodwork. Oh, you don't know what you're talking about, you're not qualified to speak. Cool, I'll get my qualifications and then I'll go after you. So if you're looking at different asset classes, and this is purely just an illustration, the return on Australian shares, residential shares, listed properties, unlisted property trusts, they're pretty much all the same, right? About 10-12% in terms of the growth per year. This is 20 years to December. Okay, this is from the Australian Bureau of Statistics. But that's not the reason we invest in these asset classes. The reason you invest in property is because of leverage, nothing else. And this is an important distinction because most investors, they look at property from an emotional perspective, meaning they buy their property that they would like to live in themselves. But that's one of the worst things you can do. And I'm going to talk about property selection and how you should select a property in a suburb. Most of the properties that I own, I don't even like them. Aesthetically, I'll never live in them. But I only buy them because of the valuation process. And I'll talk about that and why I buy certain properties. Leverage is defined as, in finance, leverage or gearing, depending on if you're talking US or England, is borrowing money to supplement existing funds for an investment in such a way that the potential positive or negative outcome is magnified or enhanced. Leverage is really the key. Let's talk about 5 different asset classes. We've got a table here. We've got asset class number 1, 2, 3, 4, and 5. 5 different investment options. Now, the growth yield is 11%, which happens to be the average capital growth of property since the Second World War in Australia, roughly. And the average interest rate is about 7%. So I've put 7% as the interest rate, and the growth yield is 11%. And you've got 5 different asset classes. Is the growth yield the same on every asset class? Yes. So asset class number 1, 2, 3, 4, 5, they're all doing 11% per year. So the only variable in this example is leverage. So let's have a look at the example. And you're starting off with $100,000 in each scenario. So in the first example, you've got $100,000, but you have no ability to borrow any money. So you have 0 debts. So there's no LVR, LVR 0. Your total value that you're controlling of the asset is $100,000. 11% on 100,000 is 11,000. Have you borrowed any money? No. So your net return is 11,000. Your cash return is 11%. Investment number 2 could be blue chip shares through margin lending. You've got $100,000, but now you're borrowing $100,000. Now, your LVR is 50%. You're controlling an asset number 2 with of $200,000. 11% on 200 is 22, but now you've borrowed money, haven't you? You've borrowed $100,000 at 7%, which is $7,000. 22 minus 7 is 15,000. Return on cash return is 15%. Number 3, 100,000, and this could be property, for example. You've got $100,000, you're borrowing 400,000. And let's forget about stamp duty and closing costs. I'm just showing an example on leverage. So you've got an 80% LVR. Your value that you're controlling now is $500,000. 11% on 500 is 55. But look at that now. You've now borrowed 400 at 7%, which is 28,000. So your net return is 27,000 or 27%. Number 4 could be property again. Now you're controlling an asset worth $1 million. 11% on $1 million is 110,000. minus 63,000 for borrowing the 900,000, 47,000, 47%. What's happening to your cash returns as your debt increases? Are you making more money? What's the only variable in every one of these exercises? Leverage. Is the return on the asset the same? Yes, it's 11%. Is the cost of borrowing funds the same? It's 7%. The more debt you have, the wealthier you become. It's that simple. But that's a very difficult... See some people going, oh, that's not right. Finding that subconscious, right? It is. So, and I'm going to go into product-specific knowledge in a second, but I can tell you, I can show you all the stuff in the world. Until you get rid of that feeling, you're not going to do anything with it. So this is a fundamental thing. Now, remember I talked about the property that I secured with no money. If there's no money in, what's your return? It's infinity, isn't it? Because you're virtually putting no money in. And the beauty of property, it's one of the very few assets that you can actually secure with no money because of the financial system. So this is a very important illustration because in a very simple way, it proves the point that it's not the return, and this is the thing, this is my pet hate with the financial planning industry. You know, when they talk about asset classes and they talk about having a balanced portfolio, they show you capital growth or yields on different markets. And they say, well, the Australian Stock Exchange 200 is doing 12%, residential property is doing 10%, and then you've got all the other, you've got mortgages and cash, etc. But you can't invest in the residential property index. There's no such thing. Is there? Can you invest in an index of suburbs? When you're investing in property, you're buying a specific house in a specific suburb. So why would a whole industry base all its fundamentals of asset allocation on a system that is completely flawed because they're comparing indexes of things that don't exist? Because there's no such thing as a residential property index. So wait for the articles to come out. So how do you optimize your structure? This is basically what I'm going to teach you now. How do you buy these properties? How do you secure it? How do you structure it? Let's say you've got an owner-occupied property and you want to buy 3 investment properties. The most important thing is, even if you want to buy one property initially and eventually build up your property portfolio, the structures have to be put in place before you do anything. Because once you do stuff with property, it's always, if you want to restructure yourself, there's always stamp duty implications, there's capital gain tax potential implications, especially if you're transferring ownership from one entity to another. So the most important thing with property is to make sure you understand where are you going, what's your goal. For example, my goal is to get 10 properties in 10 years. Okay, this is the structure you need to set up from day one that will have the ability to grow with your property portfolio from day one and be able to handle 10 properties. Not grow your structure as you're accumulating property. And this is what we see most clients doing. They go out and they find the property first and then they do everything else. That's not a good approach. So this is what your structure should look like. You've got your house and you've got 3 investment properties. The first thing you need to do is you need to understand that your house is bad debt, meaning you need to get rid of your bad debt as soon as possible. But this is the key distinction. You don't want to make it the aim of what you're doing to pay down your owner-occupied debt. You want it to happen by default of the structure. And that's done through an offset facility account, which I'm about to show you. And then you know that your property is a good debt. Now, each property has to be standalone. It cannot be cross-securitized with any other property. And each property has to have a separate loan with a separate BSB account number with a separate line of credit. Okay, now I'm going to get into more detail about this. So this is the big picture stuff. I'm going to get into product specific. Each property should also be ideally purchased in a separate entity, meaning a trust, company structure, excuse me, and trust. Now, and I'll talk about that after I talk about the banking products, because we've been recommending that people actually buy properties in trust, and I'll show you the structure that we've been recommending. Now there's a couple of things that the ATO is looking at very closely, because the structures we're recommending were so good because they gave you the benefit of asset protection through a trust, and you could have claimed all the negative gearing benefits against your income as an individual and the trust's income. Okay, so at the moment it's up in the air. We've got another way we can do it, which is modified, and I'm going to go into more details with that. So initially, when you're setting it up, you want to make sure everything's standalone. Now, the banking packages, there's actually 57 banking packages available from 29 institutions that I recommend to use for property investing, and I'm going to give you the top 5, and I'm going to give you the top 1. Okay? The advantages of having these specific products is, number 1, it's convenient banking. From the perspective, and I'll talk about what convenient banking means. There's streamlined fees, there's no annual fees on gold cards, you've got rewards programs, you've got discounts. So if we're looking at the banking packages, these are the top 5. The ANZ Break Free package, the CBA Wealth package, the NAB Choice package, the Westpac Premier Advantage, the St. George Advantage package. The annual fee that you pay for these packages is whatever it is, $340, $350. The mortgage is a minimum of $150. There's no monthly fees, no transactional fees, no account keeping fees. Now, these packages were originally designed for professionals. They're still referred to in the industry as professional packages, meaning accountants, solicitors, doctors. But in the last kind of since 2000, they've been just advertised, anyone can get these now. You also get a gold card with each one of these packages. They're the top 5. My favourite has always been the CBA Wealth package, but there's a problem with CBA because what they've done recently is that they've changed the way that they value properties. And I don't like using the CBA at all under any circumstances anymore, and I'll show you why. So my second preference is NAB. NAB's got the choice package or the professional property package, which is a variation of the choice package. Okay, so I'm going to explain to you why I've changed my mind on CBA and what they've done, and they've really just put a spanner in the works. What's the advantage of having these packages? Number 1, you get a discount off the standard variable rate. Okay, so with ANZ, for example, whatever the standard variable rate is, for loans between 150 and 250 grand, you can get 0.5% off your standard variable loan. With NAB, I didn't put anything there. For 250, you can get up to 0.92. That's the maximum they can give you. Now, if you just ring up the bank and say, can I have 0.92? No. I'll show you exactly how to do it. By the way, has anyone been to a seminar previous to this one, a 2-day seminar? Did you implement the strategy that I told you to implement of how to get the discounts? No? I had a few people last time do it. You have?
Yeah, I spoke to 21st Century Finance and they did it all.
Okay, great. Great. I'll show you how to get these discounts without any problems. It's actually quite fun. Westpac St. George. Now, I used to be a big fan of the wealth package. Now I've stopped being a fan of that because of CBA using ValX, which is an aggregator for choosing valuations. Now I'm going to talk about valuations after lunch because it really restricts my ability to revalue the property and nominate a valuer every 6 months. So they've stopped doing that. So I guess they're all pretty much the same. It's not like there's one that's better than the other. It's like saying, is a Commodore better than the Ford Falcon than the Camry? You know what? They're pretty much all the same. It just comes down to your specific situation and how you feel about each package and what it has. So it's not like one just stands out from the crowd. They're pretty much on par with each other. They have roughly the same benefits. And I'm going to explain to you what they mean and how they operate specifically. Now, before I do so, let's talk about cross-securitized lending. Now, this is one of these topics I'm going to be very blunt on. Do not cross-securitize your assets under any circumstances. And I'll explain to you what cross-securitized lending means. I'll give you an example from Perth. There was a lady that came to my event in Perth about 1.5 years ago, and she actually had a property worth $500,000 that was unencumbered. And she said to me, Konrad, I want to buy investment properties. We should have done it years ago. Our kids are gone now. We're ready to do it. And there's a mining town in Perth, and we can get 12% rental from these properties, and apparently the whole properties are booming. She goes, do you know this particular town? And I said, no, I only know really the Melbourne market, but I can tell you now I would never invest in mining towns because do you know the mine's going to be there in 20 years' time or 10 years' time? There's no guarantees. Now, some mines, like the Olympic Dam mine in Adelaide, they've got a lifespan of 150 years. The risk factor is probably lower than the mine that's probably got a lifespan of 10 years. But I said, look, do your research, but if you're asking me whether it's a good investment, I would say no. I would stick to Perth or I'd stick to the major capital cities. Not because you can't make money in outer areas, It's just more predictable and sustainable. That's all it is. It's just more conservative to invest around major capital cities. But you can make money anywhere. But I said to her, if you're asking my opinion, will I invest there? No. Am I aware of those opportunities? Yes. I get all the emails and newsletters and all the different companies that sell those properties, and I would never do it myself. She says, well, I'm going to do it anyway. I said, look, no problems. Look, I hope it all works out. She went to one of our brokers, Amanda, and she says, what's the maximum that I can borrow? And Amanda says, the maximum you can borrow is 85%, and we can give you a loan at, look, I can't remember the specifics, but let's say it's 7.5%. She went to her bank manager at the Which Bank, and he says, I want to buy this property, it's cash flow positive, it's a great property, it's in the mining town, etc., etc. What's the maximum that I can borrow? He says, I'll give you 105%. She says, but Konrad said you can't get 105% anymore. Those products have been taken off. He doesn't know what he's talking about. I'm the bank manager. I'll look after you. So she bought the property in the mining town, roughly for, I think, around about $500,000. Now, what the bank manager didn't tell her is in the actual mortgage document, there was a deed of charge which took security over 2 assets. So she's got an unencumbered property and she's buying a brand new property. Now let's say that it costs her another $50,000, and just to make it easy for illustration purposes, in closing costs and legals and stamp duty. From a banking perspective, is the bank in a good situation? Yeah. What's the total assets they are controlling? 1 million. What's the debts that they have? 550K. What's the LVR? 55%. Is that a good LVR for the bank? Yeah. It's a great LVR. So by doing one loan over 2 assets, what they've done is they've actually given her 105% finance, but they've taken a deed of charge over 2 assets. So she came back to me some time ago and she said, look, I've bought that property anyway. The town's going absolutely bananas. In fact, there's so much demand that people are renting per room, etc., because they can't keep up because the construction industry is very slow in Perth, etc., etc. I said, great. She goes, I want to buy one in Melbourne. And I said, well, how much can you borrow now? We did an assessment for her and we worked out that she can borrow around $450,000. But because she cross-securitized her assets with CBA, and this is one of the most important things that I'll show you with cross-securitization, why it's a bad thing. Even though the next property, let's say it's a $450,000 property and she's getting a loan at 7%, when they assess her next purchase, because they're doing the loan, they don't assess it at 7% interest only. They do it at 9.25 principal and interest. They add another 2.5% or 2.25% on it. So would that mean that the maximum that she can borrow gets reduced? Absolutely. So the maximum that she could have borrowed was about 300K, where with us, with another lender, could have been 450. For that, we got her into a house and land in Melbourne, in a good estate, for $300,000. And I said to her, you're going to get about 6 to 8% capital growth. This property is going to double in 10 years' time, okay? It's a conservative, good 4x2, okay? Not an issue. So she bought the property in Melbourne. The mining town, 6 months later, died. The property dropped to about $280,000. Literally, they took all the operations out to another area. Everything stopped. She settled this property, which is fine, and this property had about 8% capital growth since. It's worth probably 316, 320. The problem is now that she's stuck. She cannot do any more properties. If she only took a line of credit against the owner-occupied property for $400,000, I personally could have got her into 5 properties standalone. But because she cross-securitized all her assets and allowed the bank to take control and dictate to her what she can and can't do, eventually they can just turn the tap off. And when they turn the tap off, your breaking costs are so high, you won't be able to refinance because you're going to have to pay $60,000, $100,000 just to get out of this structure. So cross-securitization is one of the worst things you can ever do when you're buying property. We'll never do it at 21st Century Finance under any circumstances. We would rather not even give you a loan. So my staff members are not allowed to cross-securitise, and I don't even want to know the reason. Just not interested. It's never going to happen, because this is what actually happens to people. So cross-securitisation of loans is where one loan is secured by two or more properties. Many clients believe that all the loans are individually secured or are standalone. This may not be the case. The problem is that most people don't even know they're cross-securitised because it's the last page of the mortgage document. Okay, so you need to read all the small print of your terms and conditions. I'm a big fan of reading all documents. You've got to just do it. If you're getting a loan, you've got to read the whole thing, every single page. There are a few concerning clauses common to most lenders. The combined accounts and the combined security clauses. And it's imperative that you understand what these mean. The combined accounts clause allows lenders to combine accounts without prior notice. This might involve combining multiple loan accounts, or probably more concerning, combining an account in credit, like cash in bank, term deposits, savings accounts, with an account in debit, which is your mortgage or personal loan. So they can freeze your assets and internally just do a consolidation of accounts. The scary thing is that the combined security clause allows lenders, particularly in guarantee documents, which are applicable to people investing via companies and trusts, to combine assets internally. So if you're guaranteeing purchases on your children and you're with the which bank, I shouldn't pick on the which bank actually, you're with NAB and you've got a term deposit and something happens to this property over here, they can just freeze everything and do an internal consolidation. These include clauses which state that a bank can rely on any security that you have provided, you being the borrower or the guarantor of the particular loan. These types of clauses are often referred to as the all monies clauses. It is imperative to note that there is a legal doctrine of consolidation. That is, in the absence of specific terms and conditions, the all money clauses can be applied. So the banks, they on purpose make these clauses so ambiguous and so open to interpretation that they'll just take you to court. Okay? Now people will say, well, I'll fight them. Well, let me ask you something. Let's say you've got a $500,000 loan and you went under for whatever reason. Do you think the bank's going to allow you to win in court? Do you know what will happen to all the other possibilities of other clients that have cross-securitized? To get that 500 loan, they'll spend $10 million if they have to defending that one claim. It's not a commercial decision based on how much money is involved. It's about the principle and the precedent that it's going to set for future cases. So you have virtually no chance of ever defeating this in court. And they'll throw more money at this than anything else, because the moment they get one precedent that wins, it opens up a whole, potential of other people coming out of the woodwork. So there's no way you can ever win this. There are two main solutions to combat cross-securitization. Number one is to amend or strike out the all money clause, but the chances are zero. Number two is to use multiple lenders. Use multiple lenders. Therefore, you have security with multiple lenders. Now, I'm going to show you exactly how to structure this from a product-specific perspective. Now, there are advantages or downsides because, the moment you go to a bank, when I used to do this, people said, well, my bank told me, they gave me all these benefits of why I should cross-securitize, and they told me that once the property goes up in value, I can unencumber them the moment the LVRs are acceptable. Don't believe it. Don't buy into the hype. There are some advantages, disadvantages or downsides to consider before structuring portfolio via multiple lenders. Number one is this. Professional packages are cheap. You've got one-off annual fee of $350 and that's it. And with CBA Wealth Package, you can have 15 properties in one package. That's very cheap to control 15 properties and 15 multiple lines of credit with one annual fee. There's no additional fees. In addition, your lenders, you've got a relationship with your lender, which is worth a lot as well. So the relationship with your bank manager is where you can ring them up. I mean, when I was in NAB doing finance, especially for a client, which is an orthodontist or a dentist for more than 3 years in their practice, they could ring me and I could approve a car for $80,000 just on the date of birth, name, and how long they've been in their business, and they're approved. I don't need anything. I've had clients ring me saying, we're buying a property. I said, well, you're pre-approved for up to $750, go buy it. Right? That's a good relationship because I've done so much stuff for them, I already know what the balance sheet's like. But if you go with multiple lenders, you don't have that relationship because you've only got one loan per lender. Doesn't make a difference. I would still do multiple lenders, and I'll show you exactly why. Ease of borrowing money, okay, it's easier for record keeping. If you've got everything with CBA, your landlord's insurance, your properties, it's all coming on the same letterhead at the same time, it's easy to manage. Okay, otherwise you're printing off multiple statements. There's more work involved with multiple lenders as well. You've got discounts on things like car insurance, home and contents insurance, superannuation, etc., landlord's insurance. To me, despite of all those benefits, I would still not do it. Now, this is what I recommend you do, and I'm going to go into these products. If you're starting off, for example, buying an investment property, imagine this is your owner-occupied property, and let's say it's worth $500,000, and you're buying your first investment property. For the first two properties, for your first investment property, I would definitely recommend that you use the same lender, meaning that this should be in a wealth package. It could be NAB, it could be ANZ, whoever. And what you're doing is you're creating an offset facility account, which I'll explain in a second, where all your pay is going into the master facility, which I'll explain in a second. But your subsequent properties, I would not recommend putting with the same lender. I would recommend having them stand alone. So investment property number 2 with St. George, for example, or Bank West, whoever. And then each property should be with a separate lender. But your first investment property has to be linked to your home, because what you're going to do is you're going to create a system where your pay and your rental is offsetting your bad debt and diminishing your bad debt on an ongoing basis. So this is a way of you just automating the process of repaying your bad debt and concentrating on accumulating good debt. Now, I'm going to clarify this and go into more detail, but this is the big picture stuff. This is what I always recommend my clients do. First investment property, stick it with your house, with a professional property package, or subsequent property, standalone. It's all about control. I'll take questions in a second because I'm going to cover these in more detail. It's all about control versus ownership. See, people have an obsession with ownership, but the wealthy people know it's about controlling assets. There's a massive difference in the psychology of a sophisticated investor and the average person. The average person always focuses on cash flow. They always want rental out of properties. But it's equity that's going to get you the money. It's never going to be the rental. Property investing is all about capital growth. It's not about the rental. If you want cash flow out of a property, you might as well just do share lord and get your 3 to 5% a month out of a line of credit. You're going to make much more money with less headaches than you are by trying to extract rentals from an asset that is only a growth asset. The educated investor focuses on building equity and increasing their good debt, while at the same time paying down their bad debt. But it happens automatically. I remember I went to a plastic surgeon in Melbourne, and this guy's a very successful plastic surgeon. He has people coming over from all around the world to have surgery at his practice, and it's one of the top suburbs in Melbourne. And I was doing a laser for him for $280,000, which is a brand new laser to use to rejuvenate skin. And the problem we had with this person was that he wasn't declaring any income anywhere. So it was very difficult for me to actually put the loan in, because even though he was making, my estimate, over $600,000 per year, on paper there was just nothing. All his cars, his school, his boats, his holiday homes, they're all going through all these businesses and all these structures. And I remember he said to me, I said, "You're not paying any tax, you're not making any money." He goes, "I can't afford to pay for anything with my money, because for every dollar that I make, that dollar will cost me about 46 cents. That's how much tax I'm paying. But if I take a dollar out of my business or my companies through a line of credit, that will cost me around 7%, but the asset's growing at 10% and I'm getting a 4% rental yield. So it's cheaper for me to live off my businesses and my assets than it is from my actual income that I'm making. I can't afford to live off my income." Isn't it an interesting way of looking at it? So with these structures, what actually happens is you want to live off your assets and you want to have lines of credit set up, and all your expenses are coming out of these particular assets. I'm going to go into more detail about that. The true aim of a property investor is to maximize the amount of money that you control. Psychology of money. And this is where I'm going to get into very product-specific knowledge. Interest is calculated daily on the principal balance outstanding and charged monthly in arrears. Interest saved is better than the interest earned. I'll revisit these points in a second because they are a little bit abstract. By reducing a bad debt principal amount from day one, you can reduce an average 30-year principal and interest home loan down to 15 years or less and save potentially hundreds of thousands of dollars in unnecessary interest repayments. This is done through an offset account. Now, that's a definition of an offset account. I won't read you out the corporate definition. It's basically putting money straight into your bad debts or into a master facility account. Now, over time, what actually happens is your offset account can help you reduce your loan principal amount, which is your bad debt, allowing you to pay off your home loan sooner by building up equity. There are two different types of offset accounts. There's an 100% offset account and a partial offset account. We're going to do an example. Before we do the example, I'm going to show you the reality of how they work. So, what actually happens with loans is this. And you might want to copy this because it's not in your notes and it's not in the workbook that you'll be emailed on Wednesday. When you take out a loan for $500,000, principal and interest for 30 years at 8%, what actually happens is, well, how many repayments are there in that loan, first of all? There's 360, right? So halfway is 180 and you got day one. Your repayments, let's assume it's a variable rate or fixed rate, doesn't make a difference. Your repayments are roughly the same each month. Obviously, they're going to fluctuate as the interest fluctuates. But what actually happens to the interest component of your repayments is your interest looks like that. It goes down on a diminishing scale. There's a thing in lending which most lenders and brokers don't understand called forward loading. Forward loading is a system whereby the banks, even though you're doing a principal and interest loan repayment, your first repayment that you're making consists entirely of the interest component only. You're not paying any principal in your first repayment. In your middle repayment, which is your repayment 180, you're actually paying half in principal, half in interest, and your last repayment consists entirely of the principal amount. So what the banks have done, in order to stack the odds in their favour, is even though you're doing a principal and interest loan, they actually get you to pay out the interest component first. And then you start paying the principal component. So for the first 7 years on a 30-year home loan, you virtually haven't made any repayments on your principal. Okay? And this is how they work out the amount that you pay each pay cycle. So let's say, remember, interest is calculated daily on the principal amount outstanding and charged monthly in arrears. So what they do is this: Monday finishes, Monday close of business, they ask this question: what's the principal amount outstanding? $500,000. Okay, what's the interest rate? It's 8%, so it's 365 divided by 8 times 500, and that's how much that one day costs you in your mortgage repayments. Tuesday, what's the principal amount outstanding? 500. What's the effective interest rate? It's 8%, divided by 365, that's your payment for Tuesday. The whole month passes by, and there's how many days in the month, depending on the month, they add up all the repayments, and then you pay your first mortgage repayment at the end of month one. So normally what people do is, let's say you're over here, you're a couple working away. Normally when you get you've got a JOB, as George says, you get paid money into a BSB and an account number. And let's say this is with St. George or ING. And at the end of the month, you transfer the money into your loan account, which also has a BSB and an account number. Would you agree? And that's what people do traditionally with principal and interest loans, because they have the lowest interest rate on them. An offset facility account is completely different. With an offset account, what you're actually doing is, rather than your job pay going into your St. George account and you're paying for bills and then transferring there, your money goes straight into your loan account. So let's say you're a couple making, you've got incomes of about $50,000. Let's say you're making $2,000 clear a fortnight, for example. Okay? So the moment you get paid your first check in that fortnight, which is 2 weeks, when the bank calculates the interest, and there's $2,000 sitting there parked in your principal and interest P&I loan, is the amount now $500,000 or is it $498,000? $498,000. And then 2 weeks later, another $2,000 comes in. So by the end of the month, the calculations are actually on $496,000 times the 8%, divided by 365. Well, people say, well, so what? Well, what actually happens is you can pay off your home loan a lot quicker, and I'm about to show you the numbers. So what do you live off? You actually live off a credit card for 55 days interest-free, and your credit card automatically gets paid out just before the interest-free period expires on the 55th day. So all you're doing is this. Instead of putting money into St. George and paying your mortgage with NAB, you're simply setting up an offset facility with NAB. Your pay goes straight into your mortgage. You're living off a credit card for 55 days, and that credit card gets automatically paid out at the end of the 55 days. So you've got a month and a half worth of income offsetting the principal of a principal and interest loan. Now, let me show you the real figures and how this affects a typical couple. If we can just go back to the slides. Let's have a look at a typical couple. 55K each, $500,000 loan, P&I loan. In this example, the couple's outgoings and loan repayments are held constant. So I'm not changing any, I don't believe in budgeting. Okay? How many people have tried budgeting here in the past? How many are stuck with it more than 6 months? And good luck if you did. Most people just can't do it. So budgeting is very difficult. What I believe in is automation. Set and forget. In this example, the couple's outgoings and loan repayments are held constant. The only variable is where the money's going. Let's have a look at an example. Scenario 1, $500,000 home loan, 30 years, principal and interest, 8%. If you look at the repayments, this is roughly what they're looking at, between about $3,250 per month. And that's the 30-year mortgage. You can see the red line representing the component of each repayment and the interest. What would happen if they've refinanced at 9.5%, so it's higher than the P&I loan, but they introduced an offset facility? What would happen to the mortgage repayment? They'll pay off their mortgage in 15 years. Let's have a look at the saving. They would save themselves, in this scenario, $407,875.76. Now, let me ask you, is that before tax or after tax? After tax. How long would it take a couple on $55,000 to save to earn $814,000? Do you know how long? A lifetime. A lifetime. Let me show you an example for those who are still not convinced that structure is far more important than the interest rate. Let me show you a ridiculous example where we're comparing an 11.5%, which I've never even seen 11.5% since I've been in lending. I've never seen products 11.5. They did exist in the 90s, but I was at primary school then. 11.5% versus 6.5. If I had two loan opportunities for you, one for 6.5, one for 11.5, how many people not knowing structure would choose 6.5? Yeah, absolutely. Who would choose 11.5? Why would you? I want to sabotage myself, I want to pay more to the bank. You wouldn't, right? So let's have a look at the difference. 6.5, and that's cheap because your repayments are $2,750, because this is the thing, this is how we've been conditioned by the banks. Remember, we get those little letters in the mail saying your interest has been reduced? What happens to your repayments? $250 less per month. Excellent. So automatically we've been conditioned, lower interest rate, lower repayments. What they don't tell you is, and I'll show you in a second, is when you're doing a loan, they don't tell you, don't worry about the interest rate. This is the amount of dollars you'll be paying in interest for the life of the loan versus this one. If they showed you the dollars, 280,000 versus 400,000, it would be a very simple decision, would it? They've got the information. They'll never show it to you. Because banks make more money out of principal and interest loans than any other residential product. And they've created a perception that the lower the interest rate, the more saving you're making, which is BS. Let's have a look at 11.5. Let's have a look at the money. $141,839.14 and 16 years off their mortgage at 11.5 with an offset facility. That's $282,000. So what the bank should really do, now why don't banks do this? Because the bank's number one priority is what? Dividends to shareholders, shares. They want to maximise profitability. Loans, the way loans should be structured is when you're signing up for a loan, a P&I loan, they should say with this loan, you're repaying 500 worth of the principal and you're paying 280,000 worth of interest. With this one, you're paying 130 worth of interest, but it's a different structure. And then you could make an educated decision. Would you agree with that? Instead of giving you the interest rate, which means stuff all, it doesn't mean anything. But it gets worse than this. Let me show you the worst part. Going back to the same example, if we look at the life of a loan of $500,000 and you look at the repayments, repayment number 180 is pretty much half principal. Let's say the black colour represents principal repayments and the red interest. And the last one, which is 360, is pretty much predominantly all principal. Your first repayment that you're making is pretty much all interest. And the middle one's half-half, roughly, right? Should actually be the other way around, but doesn't make a difference. Now, with the same loan, normally interest-only loans are cheaper in terms of repayments per a particular period of time than interest only. Would you agree with that? So if you've got a loan for $500,000, let's say your monthly repayments on the principal and interest are $3,500 and interest only are $2,500. So what's the difference between the two? $1,000. If you want to pay out this loan a lot quicker, what you should do, I'm about to give you $1 million tip here, is do an interest-only loan that has no penalties for paying it out earlier and make the additional repayment of $1,000 or the difference between the interest-only loan and the principal and interest loan. Do you know why? Because with your first repayment, what you've effectively done is you've taken $1,000 straight off the principal amount from the first month. The second month, you've taken another $1,000. So by month 2, your mortgage goes to $499 to $498. Does everyone understand that? So let me be blunt with this. There is no reason why anyone should have a principal and interest loan under any circumstances ever. Even if your goal is to pay out one house and never invest in your lifetime, you should do interest only and you should make the additional repayments every month, which is the difference between the principal and interest and the interest only loan. This will pay out your house a lot quicker than any other structure. So I've never heard of a reason in the last 10 years why anyone should have a principal and interest home loan. Turn to the person next to you for 30 seconds, tell them how much you hate your bank manager now. So I'm going to show you how to optimize your structure now in terms of how all this works and why. But it's interesting how much conditioning we've had from the banking system, isn't it? How everyone's been conditioned to a principal and interest loan because our perception is it's got the cheapest interest rates, therefore it's the most savings. See, interest rates don't exist. The only thing that exists is how much you're actually paying over the life of the loan. That's the only thing that exists. The rest is irrelevant. So going back to the structure, if you look at your property portfolio, there's your house. You've got individual lines of credit, bad debt, good debt. How would you buy your first investment property and then how would you settle it and then what would it look like? The first thing we would do, let's say you've got an owner-occupied property with $500,000. There's your property, it's worth $500,000. And you've got a loan with $200,000 against that property. So you've got an equity of 300. Normally what banks would love to do is use that as security for your next property. And by doing so, they'll give you the best rate you can possibly imagine because they know that they are doing one loan against two assets. What we do is we set up what's called a master facility, which is simply a line of credit. Now, if you've got a $500,000 an asset and you've got a loan for 200, you know you can borrow up to 80% against 500, which is 400. So you've got a loan for 200, so we set up another line of credit, which is standalone for $200,000. So you've got a standalone loan for $200,000. And now you want to buy your first investment property. I'll take questions at the end of this, so please write them down. I'll go through. So you've got an investment property for $500,000 that you're buying. It's your first investment property. There it is there. You're doing a 90% loan, which you still can do with every lender, not an issue. It's the maximum. Maximum is Bankwest 97, CBA will do 95, okay? But you've got to be with them for 6 months. So there's still lenders out there, but 90% is just very easy. You need to put a deposit down on $50,000, which is 10%, and you need to come up with $25,000 in legals and stamp duty. So that money comes out of your line of credit. This is with one bank, this is with a completely other bank. You're using cash as a deposit. You're literally transferring money into the solicitor's trust account, who's acting on behalf of the vendor. And then you're getting a mortgage through a separate lender. The most important thing is there's no link between this house and this house. They stand alone. If it's your first investment property, I would recommend that you use the same financial institution, because what you want to do is set up an offset facility and you want to have one investment property that is linked to your owner-occupied property. Why? Because this master facility should be, all your rentals should be going straight in there, as well as your income. Because this facility is also linked to this loan here. So it's offsetting your principal loan from day one. So very simply, you've got the professional property package with NAB. You've got one investment property and you said you're buying another one. And then you're going to ANZ and you're doing your other investment property. This particular house has the master facility line of credit. That line of credit is used as a deposit to buy that property. But the loan is with ANZ. There is no link between these properties in any way, shape or form. Okay, so NAB doesn't control this property. They don't need to even know that it's there. And then after that, you buy another one in another entity. Now, the moment you have a property, the only loans that I recommend, and I'm going to talk about interest-only loans as well, I don't recommend anyone fixing loans, okay? Now, I'll show you how you can predict where loans will be. So if you just go back to the slides. So when we are structuring loans for you, and this is where you're first, when you're getting into the industry, I would actually recommend that you get a mortgage broker to do this for you. Okay, I actually recommend that you get someone that can set this up for you, tell them how you want your offset facility set up specifically, and get them to help you to do that, and maybe help you with your first investment property. After that, I actually recommend that you go directly to the bank and deal with bank managers. Now, this is an example of a really good structure which ING does. ING's got one of the best offset facilities, which is called the all-in-one account or the money manager. And in this example, your income is going into an all-in-one loan account. You can do P&I repayments or you can do interest-only repayments into your Advantage rate loan. Now, we spent a whole day training our brokers just on this one product. So I'm going to cover it in 3 minutes with you guys, and you're not in the industry. So I don't want you to become experts on this package. I just want you to understand that it's there. And if you need to have more information, either see our guys or go directly to ING. The beauty of this product is that ING is the only one that has an interest-free credit card where you can get cash out of an ATM and it's not a cash advance. Okay, because what I found, what no one told me this when I did, is that I did all this stuff and then I've got, like I want to get a coffee and I've got no money. And if I take money out, it's an advance. Okay, so ING's got a really good product where for 30 days you have interest-free cash out of a credit card, interest-free. You can take cash out of an ATM. which is great because then you still need cash to function, to buy lunch and to buy things. So that's the ING example. So when we talk about loan structuring benefits, we're talking about effective use of your income and cash flow. And this is what this particular package does. Now, by the way, I'm not saying ING's got the best product. I'm just giving examples of different products that are out there. It's up to you guys to go out and inform yourself. But you've got all your available income or cash flow deposited directly into your all-in-one home loan account and reduce the amount of interest that you pay. It's not about how much interest rate you are paying on your interest. It's to reduce the amount that you're paying in dollars. That's the key. Has everyone made that transition? It's not the 8-9%, it's the dollar amount. You've got to get rid of the dollar amount. With the all-in-one account, you have access to banking facilities, all banking facilities, such as internet and telephone banking, EFTPOS, checks and deposits, BPay, salary crediting, direct debits with no electronic transaction fees. Remember, it's a professional package. You only pay $340 per year for this package, or $350. There's no other expenses. So you can do all your online banking, you can buy stuff, you can go direct debit, you can write checks for properties when you're buying investment properties. You've got full flexibility. Never pay credit card interest again with the amazing NEVA nil interest Visa card. Your NEVA card can be used for all your monthly expenses, including cash withdrawals, interest-free for 30 days, which is great. So it's a very effective way of using money or debt. This helps you further reduce your interest charge by allowing you to leave your cash flow in your home loan for up to 30 days. Unlike other lenders who will charge you excessive credit card fees if you don't have enough money in your actual account. And it's got other flexibilities in there. I've just taken this straight out of the website just to show you how it works. So this is probably the most important thing. Before we even look at property selection, it's actually getting that system of automation and how to do it. Now, let me show you how you can save a lot of money off your mortgage. This is what you do. I do this in the winter in Melbourne because it rains and I'm bored, right? So I ring up the bank and this is what I say. I ring up the call centre after I go through the menu system, and I say, "Hi, I'm Konrad Bobilak. Can you please fax a mortgage payout letter to my accountant? Here's the fax number." Do not talk to the person that picks up the phone. They're probably, first of all, they're overseas and they have zero discretion. They get paid to clear the phone lines, right? To pick up the calls. So can you please give me a payout figure on my mortgage and fax the letter to my accountant, or fax the letter to me? And then you hang up the phone and you wait. Guess who calls you back? It's the client retention manager. "Konrad, you're leaving us." "Yes, Bill. Because I just went to ANZ, and because I've got a loan that has no exit fees," okay, and I'll talk about which loans you should always take, "they're giving me a 0.5 discount off the standard variable rate. Can you match that or beat it?" And they'll beat it. They'll match it at least. If not, they'll beat it by another 0.05. So write this down. Every 6 months, threaten to leave all your lenders. Who likes that idea? And don't negotiate with the person on the phone. Remember, the person that picks up the phone has no power. They get paid to clear the phone line. It's the client retention manager that wants to keep you on their books. And that's all you do. It's that simple. You ring up, don't even say I'm going to leave, just fax it through. It's a trick. They get trained to do this. Okay, the moment they do the balance on your payout, they automatically want to call you. Now, if you're doing an interest-only loan and you've got exit fees of 3.5% on a diminishing scale because you went for the cheapest interest rate, do you think they're going to call you back? No way. That's why you always go for interest-only with no exit fees. You always want to have the flexibility to refinance all your loans every 6 months and pay no exit fees. And that's also very important for when I cover the valuation process, because you want to be able to revalue your property and increase your lines of credit every 6 months. So remember, when you're talking about banking packages, there's cost versus flexibility. The higher the cost to you, or I should put it differently, the higher the interest rate, the higher the flexibility. The lower the interest rate, the lower the flexibility. As an investor, if you're aggressively building your property portfolio and you're refinancing your properties constantly and you're increasing your lines of credit and you're negotiating every 6 months, you want to go for the highest interest rate because it will likely be the highest flexibility. Because if you've got exit fees on a diminishing scale, 3.5%, 2.5%, 1.5% for the first 3 years, you have virtually no negotiating power with the banks. The ones they only negotiate with are the ones that can leave, and the bank has lost money on the transaction because it's only been 6 months that they've taken out the loan. That's a loss to them. They're the ones they'll call. So it's a different mindset, isn't it? Because people have always been conditioned to go for the cheapest. Because why do we go for the cheapest? Because we believe, based on your current knowledge system, that it's going to translate to savings. But I've just shown you it's the opposite, isn't it? It's the structure that's going to save you money. It's not the actual interest rate and the numbers. The whole purpose of this is to create wealth at the end of the day, which is using what you have to build wealth and to maximise the tax benefits from your income. Turn to the person next to you just for 30 seconds and just teach them what you've learned in the last 5 minutes. Okay, let's come back. Now, capitalising interest, this is probably the most... every topic that I've covered so far kind of builds on the previous topic. And the most often thing that is hard for people to visualise is how do you get to these large property portfolios? Like I understand the rentals coming in, but there's a gap between the rental and the mortgage repayment. So how do you do it? The way you do it is because you're buying properties, and I'll teach you how to select properties that has the potential for the highest capital growth. You'll never be in a situation that your rental will be covering your income. If you want to build a slow property portfolio, this is what you do. You've got your house. You wait for a line of credit for $200,000. You put it down a 20% deposit for your next property purchase, which might have an interest-only repayment of 7% and a rental yield of 4%. You wait for it to be cash flow positive or neutral, which will probably take you 7 to 8 years. Then you get another line of credit. Then you buy another one. Now, this system, you get 4 properties in 30 years. Okay, but it's so safe and predictable, it's not funny. What you're going to have to resort to is capitalising interest. You're going to have to use debt to pay for more debt. Now, this is why it's so important to select properties that have high capital growth. Because if you're buying properties in outer areas, it's not that outer areas don't do well in capital growth, because in Victoria, for example, Bendigo and Ballarat do quite well. They're massive towns, and they've done quite well in terms of capital growth. They've doubled every 10 years consistently. The problem with those areas is they plateau for 3 to 5 years, meaning there's no capital growth for 3 or 5 years virtually, and then there's a boom because there's a spillover in effect from the major capital city. As an investor, you cannot afford to have that plateau for 3 to 5 years because you're missing out on the opportunity cost of buying more assets and potential capital growth on the other assets. So the only reason that I choose inner city properties, when I say inner city, not the city itself, but suburbs just around the city, which we call blue chip suburbs, is because they have a predictable and sustainable capital growth, which means I can continuously refinance them. And I'm going to show you a blueprint how you can apply the same methodology I apply in Melbourne and Sydney, you can apply it in Brisbane. I'm going to show you using RP data the exact demographics and price point that you should be targeting areas for if you want this kind of system to work for you. Capitalising interest consists of paying the gap between the rental and the mortgage with another line of credit. Okay? Now there's actually products on the market that will do this for you, and I'm going to show you the product that does this for you, but I'm going to explain the fundamentals to you before we do that. When I say a product, you can go to ING and get the money manager, put a 20% deposit, walk away from the property, and you never have to add to it again. You automatically capitalise the interest for you. So let me show you the example. This is capitalising interest. Now, by the way, people, when they see this, they go, shit, this is new. Let me tell you, I've got clients. Now, people even think that you can't capitalise interest prior to the late 80s because that's when Citibank introduced the line of credit into Australia. Let me tell you, I've had clients capitalising interest since the 60s and 70s. They were doing it manually by getting a mortgage against the property, cashing out money, putting it into a savings account and writing monthly checks. So you've got to understand there's been nothing new in finance since the 50s and 60s. There's nothing new. It's the same stuff, repackaged, rebranded, And there's a perception of new innovation. There's nothing new. It's the same principles. And that's the thing. So the one I'm showing you here has been around for decades. I didn't invent any of this stuff. It's just that most people haven't been exposed to this information. That's all it is. Based on your credit limit, repayments can be structured at a low amount to suit your cash flow needs over a designated period of time. I'm going to show you how to turn a townhouse now in Melbourne or Sydney from cash flow negative into cash flow neutral or positive in 30 or 60 days. Who'd like to learn that? Yeah. So I'm going to show you how to do it, how to automate it, how to walk away from it. Increase when the limit on the equity account is reached. At the end of that period, repayments will revert to the standard payments, blah, blah, blah. Don't worry about the jargon. Let me just show you the example. In this example, we'll consider a $450,000 property. I actually did this with a client. Property Direct actually sourced 4 townhouses in an area called Brooklyn in Melbourne, which is 9 k's from the city, and the properties that we sourced in there were townhouses at exactly $450,000. Okay, so we actually did this with a property currently in Melbourne for our clients. So we've got a property here for $450,000. The current value of the property is $450,000, and I'm going to go step by step, this example. So we've got a $450,000 property. Now, when you settle this property, you're actually getting a 90% lend against this property. So if you just go back to the slides for a second, to the PowerPoint. So the 90% LVR level, 90% of 450 is 405,000. The 80% LVR level is 360. So with this example, even though you're borrowing 90%, you're putting in a 20% deposit to buy this property. So what's 20% of 450,000? $90,000. So you're putting in a $90,000 deposit. So what actually happens to the property is that you've got 2 loans at the end. You've got one loan which is $360,000, and you've got a line of credit for $45,000. Two loans. Now, a lot of people don't know, but when you get a loan with ING or NAB for $500,000, you don't need to get one loan. You can actually get 10 loans or 20 loans. With ING, you can get as many splits, what we call splits in the industry, or individual loans, as long as they are more than $25,000 each. So you can get one loan that's variable, one that's fixed, whatever. Brokers just don't do it, and ING and banks don't want to do it because it's too much work, because they're doing 20 times the work for one loan, okay? But you can. If you ask for it, they have to give it to you. So in this particular example, we're buying a $450,000 property. When we settle the property, we've got a loan for $360 and another loan for $45. Together, what's 45 plus $360? $405, which is 90% LVR. The other $45,000, because we're putting a $90,000 deposit, just ends up in the interest-only payment. Let's say this townhouse costs you, let's say you've got no income. You've bought this property, and it's costing you $250 a week to add to the property, which is $1,000 a month. Is that fairly good? $1,000 a month. If you're an average income earner on $55,000, after that $1,000 a month, would you buy a second property in a hurry? No way, because you haven't got another $1,000 that you can add. So with this particular property, when you settle the property, what the bank allows you to do is, instead of taking that $1,000 out of your pay, they allow you to take $1,000 each month out of the line of credit. So here's a very hard question. How many months are there of $1,000 in 45,000? 45 months. How many years is that?
Nearly 4.
Yeah, nearly 4. It's about 3.75, right? So here's what it looks like. You buy a house let's go for Brooklyn. Brooklyn has an average capital growth of about 9.5%. It's one of the cheapest suburbs within 9k radius of Melbourne. It's got an average reputation. Traditionally, I would say 10 years ago, you could have referred to it as crap. Now it's called up and coming because it's close to the city. It's funny how the crap from 10 years ago is up and coming though, isn't it? So we know that this property will double to $900,000 in, let's say, in 7 years' time. Okay, or whatever you want to go. Let's go for 10 years. Would that be conservative? 10 years' time will go to 900,000. For the first nearly 4 years, or 3.75 years, are you putting any money to add to the rental? No. So you've got a line of credit which goes from $45,000 down to zero. What happens in year, so this is 2010, what happens in 2014? You revalue the property and you increase your line of credit automatically. Because now the property, instead of $450, is worth about $650. So you've got another line of credit for $45,000. But because your rental's going up all the time, that $45,000 now, instead of 4 years, will take you to 6 years. Because your rental's going up. You don't need $1,000 every month. So if you look at the transaction now, it's year 10. Have you contributed any money personally from your job? No. If you want to sell the property, it's worth $900,000. You've got the original debt of $450,000. Plus, you've used 2 lots of lines of credit, number 1, number 2, to get to year 10. What's 2 times 45,000? 90,000. 450 plus 90 is 540 minus 900, so you've made 360,000 in profit. How much money have you spent to hold this property? Why aren't you guys doing this? Turn to the person next to you for 30 seconds, explain capitalising interest and how it works. Okay, let's come back. So this strategy is actually perfect for people that are close to retirement or retiring. They've got a lot of equity in the property, but they don't have cash flow coming in consistently. And this is where you can buy townhouses in the major capital cities. Now, 450 is difficult to buy these days, but I mean, 550, 600 will get you a good townhouse in an area that's fairly close to the city. But you could buy this with the ING money manager, put a 20% deposit down, turn the key and walk away, and there are no contributions from any of your income because the 20% deposit that you've put in there is covering all your expenses. Now remember, rentals are going up a lot. In fact, my prediction is, and it's not even my prediction, if you look at the literature now from people like the Real Estate Institute of Victoria and New South Wales, is the next 5 years, rentals are going to go up by 30 to even 50% in key areas because they haven't really been doing anything for the last few years. They've been fairly stagnant, but capital growth has been going up dramatically. So this is one of the best times where you can go and buy a townhouse. And I say townhouse because in Melbourne and Sydney, townhouses are the best properties you can invest in. In Queensland, people like big blocks and big houses, right? But in Melbourne for rental, people don't want the land because it bloody rains all the time, right? We're not out having barbecues and swimming in the pools like you guys do. We're indoors, okay? But we want the privacy of a house. We want the space internally of a house. We want the 3 bedrooms and, you know, all that kind of stuff. But we're not necessarily interested in the grounds. So in order to get a property in an established area, Melbourne and Sydney, you want a townhouse which is 1 of 4 or 1 of 3 in an inner city area. They're the best properties to go for in terms of capital growth. Houses are too expensive. You won't get the rental. Okay, you're spending a lot of money for houses in established areas. The key with this strategy is the property has to have consistent capital growth. Don't do this with outer area properties because if your property doesn't grow, doubles in 7 or 10 years, you're going to be stuck with negative equity, which means you're going to be selling the property at a loss. So if you're going to do this, in Melbourne, I would stick to the 10, 12k radius. Southeast and Bayside, you can go up to 20k's. In Sydney, it's the same thing. I would stick to the blue chip areas in Sydney. Sydney is very difficult to talk about a radius because it's all based on waterfront properties. Very simple, 450 property, 20% deposit, and the company ING allows you to use half of that deposit to pay for your shortfall. That's all it is. And people have been doing this for a long time. Now, if you've got a negative association with debt, are you going to be doing this? You're using debt to pay for debt. You know, my parents would think this is, you know, this is illegal or it's got to be fattening at least. In this example, we use the cash flow money manager to turn negatively geared property into cash flow neutral. The assumptions we make in this example is that the funding is 9.5. So I'm not talking about, people coming out, oh, I just bought a property because I got a 4.99% loan, my rental's 4%. That's such a dangerous time for people. Because if they're just making it now, what's going to happen when the interest go up to 9.5? Because they can. They've been there in the past. Is it going to happen this year or next year? Probably not, but it could happen in a number of years. I'll give you an example where the rental yield's 4.5, the cost of funding is 9.5, so you've got a shortfall of 5%. That's a serious shortfall, isn't it? So in this example, if you look at what actually happens is this is the structure of the actual money manager at 450 with a 360 repayment. So you're actually contributing $1,300 per month through your line of credit. I won't go through this in detail because this is what we use to train our guys on how to explain this product to clients. And once again, we spend a whole day just on this one product. I'm spending 3 minutes with you guys today. So all I want you to do is be aware of it, know where to go to get more information, and understand roughly how it works. It's exactly the same as the previous example of an offset facility. And what actually happens to the line of credit and the LVRs is this. At settlement, you've got a line of credit for $45,000 and you can capitalise from the 80% LVR up to the 90% LVR. In this example, you've got the interest that you're capitalising is 5.3%. Okay, so every year you're using your line of credit. So it goes from 80% to 83.9 to 86, 88, 90. What are you doing year 4 with the property? Revalue, increase your line of credit and start doing it again. But remember, your rental keeps going up, doesn't it? And your rental's going up faster than the cost of your interest on capitalising the actual interest component. So by year 9 or 10 or 11, this property is cash flow neutral anyway, despite the fact that you've used an additional amount of money to hold on to it. So to illustrate it in another way is this. If you're buying a property, let's say your cost of funding is, say, 7%. Your rental's going to start out somewhere here. Maybe it's 4%, maybe it's 3.5%. And this is time. But what actually happens to your rental over time, it keeps going up, doesn't it? And there's a point where the property is going to be cash flow neutral, where your rental will equal your mortgage repayments on the property, on your interest-only loan. What you're effectively doing with this particular property, see here it's cash flow positive. So this is not the problem. The problem is how do we get through these 7 to 10 years? And how you get through that is you borrow against the future capital growth of the property. Because every line of credit that you use, this could be $45,000, you're actually putting that money into there when it matters. That's all you're doing. So you're ending up with more debt in the long run, but in the long run, it doesn't make a difference. Now, let me give you an example. Like, if I look at my wife's parents, for example, they bought a house in Melbourne in the 50s for about $12,000. Okay? Now it's worth probably around, I would say, $750. So, and this is the thing with, if you're looking at, say, 1950s, $12,000. Now, they did a principal and interest loan, and that was a lot of money back then. People look at those, and I'll talk about properties and median prices and look at historical data. That was a lot of money. But imagine they never paid the principal off. They did interest only. And today, the property is worth $750, and they've still got a $12,000 principal amount outstanding. Would you be depressed with a $12,000 principal amount outstanding? Like, would you be stressed every night looking at the $12,000? And what if instead of the additional payments that they spend on the principal, they just bought the place next door for $12,000 and put a tenant in there? And today, they would have an asset with another $750. Not even the research, just next door. At 5% rental yield, or let's say it's 4% rental yield on $750, is that a fairly good income in their retirement? Or even if they wanted to pay out this loan, and this is how stupid principal and interest loans are. Let's say they did a 30-year home loan, and it took them 25 years to pay it out. Why not just buy the property next door with interest only, put a tenant in there, and then in year 12 or 15, when that property goes to 24,000, just sell it and pay out your own property. Wouldn't it be easier? Like in 15 years' time, the property will more than double. It would not only cover the principal of your property, but you have enough money to pay for any kind of tax and capital gains tax. So 30-year home loans that are principal and interest, to me, are a dinosaur product, shouldn't even be around. Why are they around? Because they make the banks the most amount of money. And if something's making a lot of money, are you going to sit there? Imagine the bank has a meeting. Let's get rid of the highest yielding product that we have. What do you reckon? Any votes? Do you think that person's going to have a career in the bank? No, and this is the reason why they actually exist. This is the last section. I'm going to take questions after this. To fix or not to fix? Statistically, write this down. 80% of people that have fixed their interests historically since 1950 were worse off if they left them variable. So 80% of people that are historically in Australia have fixed their interest were worse off than if they left them variable, meaning they actually would have spent less money in interest repayments if they've just allowed the market to do what it's going to do. The unfortunate thing is that in 89 to 91, a lot of people got wiped out because they had variable loans, because variable loans went up to 18, 90%. If you're looking at, this is fairly old statistics now, but if you're looking at interest rates, they're fairly closely linked to the CPI index. And really, if you're looking at fixed versus variable, if you want to know where the market is, I would recommend that you Google the Sydney Futures Exchange yield curve for cash rate futures. Now, I've used an older slide here just to give you an illustration. In April 2009, this futures exchange yield curve suggested that the cash rate would fall to approximately 2.4% during September and October this year. Did it fall that low? No, it went to 3%, right? 3.25. This represents an expected further 60 basis points cut from the current cash rate. So this is a slide way back saying that the lowest point is going to be in September, October, roughly there. And it never reached that point, okay? He actually stayed above it. If we're looking at, this is 31st of August 2009, you can see the lowest point in the market was way back then, and now it's going up. Now, I was telling people to fix their rates. Who saw me speak in August, September? I was saying, don't fix them, guys. If you want to fix them, this is the lowest point in the market, but I still wouldn't fix. I would still have them variable, because the moment you fix something for 5, 10 years, you have exit fees, which means you have no control over the property. You can't increase your line of credit. You can't refinance your property. So you're giving up power to save money. But you're not in the game of saving money. You're in the game of building wealth. So to me, it just doesn't make sense to fix anything, half fixing or full fixing. Unless you just want to have one house and you want to pay it out as quick as possible. But even then, I would do an offset facility. Like, I just can't see why people would fix anything. They say, oh, it's taking the risk out of the biggest variable. But it depends on your knowledge. Your risk is linked to you as an investor. I always say investing is not risky. It's the investor that's the risk. Would you agree with that? So if we're looking at fixed rates, you can get 10-year rates at, historically very low levels, but I'm still against fixing, in my opinion. And when I cover the valuation section after lunch of how to continuously revalue your properties and create capital growth, I think most of you will agree at the end that if you want to do the system that I'm teaching you, it doesn't make sense to fix. So if you're looking at different sources, RP data is also a very good source for rates, but I would still be against it. You're currently at the crossroads of your financial future. I often say, and this is, what's the single most important thing about this 2-day event? Is what you do afterwards. Education is not that important if you don't implement it. Would you agree? So the most important thing about this event is what you do on Monday. Because if you sit here for 2 days and you learn all this information and you don't take any action on Monday, is anything going to change? Absolutely nothing. So if you can just grab those financial fact finders, and can I have a copy of those forms as well? I've left yesterday, everyone was given a brochure on 21st century finance and the financial fact finder. I just want to spend a little bit of time explaining that and what it entails. If you want to have a one-on-one consultation, now all our mortgage brokers are in Melbourne, number one. We do service all of Australia. if you need to sit down with a broker, we do come here quite frequently. So you can actually request to have a face-to-face next time they're in town, and they will see you at the 4-day event. The most important thing about this is you've got a bit of literature about a company and what we do. Inside the actual form, you have what's called the financial fact finder. So this is what the brokers really need. Now, the first page is just your details, but you can also use this form to request to be contacted by accounting, by Property Direct, by insurance, because we all work together. Our insurance department is in New South Wales. Our accounting department's in Perth. Our brokering's in Melbourne. Okay, so we're a national company. We're everywhere. The most important thing is the assets and liabilities section. So I don't want you to rush through this form, because the more information you put there, product-specific information, the interest rates, your assets and liabilities, the better quality conversation the broker can have with you. The last page is just your goals. You don't need to fill this out, by the way, the goals section, but what they really need is your assets and liabilities. How much is your house worth? What are the assets and liabilities? That's the most important thing. Now, if you need additional writing space, I would suggest, if you do have like multiple loans and it's quite complex, take your time and just have an additional piece of paper there and just elaborate on it. Don't try to squeeze everything on one page, because it might be too messy for them to understand. And all you got to do is basically hand this in either today, or you can fax it to us during the week, and they'll give you a free 1-hour consultation over the phone to see if we can in any way add value to you. If we can't add value to you, we're not going to do anything. We're not going to refinance you just for the sake of refinancing you. So we can tell you, look, currently we can see we can do better rates for you, better structure, this and that. So this is a free service, so I encourage you to fill this out during your lunch break, or you can fax it through during the week. Now, what I'm going to do now is I'm going to take some questions.
My name's Judy, and Konrad, I just didn't understand what you were saying about the changes that CBA have made to their wealth package.
Oh, very good. Normally what happens is, now I'm going to talk about this after lunch, but normally what happens is, when I buy a property and I settle that property, I form a relationship with the actual valuer that's used for the valuation process of that property. And what I do is I actually request a private valuation. I'm going to cover this after lunch. And then I have that valuation reassigned back to the bank. And the bank has to lend me money against that valuation. With CBA, what they've done is, because people were doing this, people like me, they've actually changed the rules. And now the brokers or the bankers cannot request specific valuers to be used for a loan. They use a company called ValX, which is an external company, and they assign whichever valuer they like. And you can't challenge the valuations, and you can't reassign or redirect valuations. So to me, it just took the whole fun out of banking. Because the whole purpose of buying a property is the moment you get a higher comparable sale, you revalue your property and increase the line of credit. I don't care what the suburb does. Like, to me, people say, oh, your suburbs did 12%. It's not the suburb that matters, it's the relationship between the property that I own and another property that has a higher comparable sale potential. So CBA changed the rules. I've stopped recommending them, because to me, it doesn't work with the strategy that I use. Because I'm going to teach you after lunch how you can control the property and the price of the property. So you can increase the value of the property every 6 months, regardless of what the market's doing. Okay? But it's got to be very specific suburbs, and I'm going to show you how to find those suburbs in Brisbane. You can find them in every major capital city. It's based on the demographics, income, and the price point of the properties. Yeah. So I'll come back to that question after lunch. It's a very good question.
Konrad, it's Kevin. I own a property here in Brisbane. I'm living in Adelaide. I'm at the present renting in Adelaide, and I'm renting the property up here. The way you've set it up originally, can we still do that if we're renting a property?
The offset facility?
Yeah.
Yes, you can. Yes. It just means that it's actually a very good question, because let's say you've got an owner-occupied property, and then you've got an investment property and an investment property. Even if you pay out your owner-occupied property or you're renting a property, I would recommend setting up an offset facility eventually on one of your investment properties. Let's say we've got clients that the goal is always just to have a property paid out completely. Okay, with the title in the safety deposit box, and that's it, we know it's ours. Great. If it's an emotional feeling that they're going for, and it's it's a feeling of accomplishment, and that's the goal. That was always the goal, to pay out the house. Then what I recommended to them is when you buy your first investment property, or choose one of your investment properties and offset that property through your income and your rentals. You should always be offsetting one property, because you're getting free capital, you're creating capital for no money, and you're reducing the balance. So you're just creating more lines of credit or capital, or equity in the property to buy more properties. Because it doesn't cost you anything. All you're doing is you're living off a credit card, and your pay is going straight into a loan rather than going to a savings account. So yes, definitely, if you're renting, you can still do it. It would just be obviously not your owner occupied. It'll be one investment property. Yes, good question. Anyone in the third row there? Yes, wait for the mic so everyone can hear.
What if there was no owner-occupied property involved? It was just, your first property would be an investment property.
Then you can still offset that one. Yes. Yeah. Now, by the way, people ask me, okay, should I buy my house and then buy properties, or should we rent? Okay, from a serviceability perspective, if you buy a property for $500,000, this is your owner-occupied property, this is your investment property. Both are $500,000. If it's owner-occupied and you're doing interest only at 7%, you're paying $35,000 per year. Is there a tenant in there? If you look at your DSR ratios, is that a $35,000 loan against your name? Yes. If you've got an investment property, you're paying 7% interest, but you've got 4% coming in rent, you're only paying the gap, which is 3%. 3% on 500, $15,000. From a DSR perspective, which one can you borrow more money? This one, because there's rental coming in. Because remember, it's just income. 80% of rental, 30% of your income. So from a purely financial perspective, if you don't have an owner-occupied debt, you can borrow more money and buy property quicker, full stop. It's not even an opinion, it's a fact. But see, from an emotional perspective, so for example, we rented up to a couple of years ago, and we just rented townhouses in really nice areas in Melbourne because I just didn't believe in ownership. Because even if you pay out the house, what happens if you don't pay council rates for 5 years or 10 years? Can they repossess the property? Yeah, so you never own it, do you? And that happened in New South Wales. I've got articles about, the old grandmother that forgot to pay her taxes and council rates for 20 years, and they came and just repossessed the property, and it was paid out years ago. So ownership to me is non-existent. It's about lifestyle, because you can rent the property that you want to live in for a fraction of the cost that it will cost you to own it. However, what's the point of the whole thing? If my wife, for example, she just wants the property, Konrad, I know, I understand all the numbers. I get it, okay? But I want the house. Fine. So, and this is the thing, we're just at the stage where we're planning to have children, and she says, I just want to have the house. I don't know, it's not, we want to have the house and the garden and this, that, the other. So I said, fine, cool, we'll do it, okay? There it is. So, but that's an emotional decision, isn't it? But she's in charge anyway, so. Otherwise my life's going to be very difficult. So we've got two different things there. We've got an emotional decision and we've got a financial decision. From a financial perspective, if you're young, and this is how we did it. We just rented properties that we like to rent, which were predominantly townhouses in close to the city, and we just bought. But eventually get to the stage where it's not that important, is it? Because there's only so much money you can make before it just becomes irrelevant. It becomes lifestyle decisions. So emotionally, when you get to the stage where you just want to have your house because it's yours, even though the bank owns most of it, but if the only thing is, I guess, if you want to paint a wall or put a painting up, you don't need to ring anyone, right? Then that's fine. Does that answer the question? Yeah. So if you're young, starting out, owner-occupied, one of the worst things you can do, because there's no tenant in there offsetting the loan. It's much easier for you to buy. You can secure more assets quicker by renting and buying investment properties. Just questions here on this side. Let's go to the front row here. We've got a gentleman here just in the front row. We'll come back to that section.
With an interest-only loan, do you still have a principal to pay at some stage, or how?
No.
I don't understand the difference between principal and interest only.
Yeah. So basically, with the principal and interest loan, if you take out a loan for $500,000 and it's interest only, they actually put in that it's interest only for 25 or 30 years. That because the calculators, the banks are not designed to go, it's infinite. But at the end of the 30 years, you still own $500,000. Your principal never diminishes. You're just paying, if you're paying 7% interest only on 500, you're just paying the interest component every month. So you never pay the principal out. So after year 10, after year 20, after year 30, you're still 500 is still there. With a principal and interest loan, and if it's 30 years, at the end of the 30 years, your balance is zero. So with every repayment, there's a portion that goes towards the 500 and a portion that goes to the interest.
So with the interest only loan, do you still own the house, or
Control.
Well, you control it, but the example is, for example, if my wife's parents never paid the principal off, today they'll have a $12,000, because they bought it for 12 grand in 1950s, and now it's worth $750. So they've got $12,000, which is virtually nothing. So I mean, we think about now. This is the other thing when I talk about capital growth of properties, and I'll show you the median price for properties in Australia. Property in Australia has always been extremely expensive as a percentage of annual household income. In fact, the average household income spends on average, historically, the last 50 years, between 35 and 69% of their income just to pay their mortgage. So when we talk about $12,000 in 1950s, people laugh at that, comparable to today. But let me tell you, back then, that was as expensive as $550 today. So property has always been extremely expensive. So to answer your question, ownership depends on how you look at ownership. But if you want to have wealth, you're better doing interest only and securing multiple properties. And then if you want to pay them out, sell half of them and pay out the other half. But the worst thing you can do is do a principal and interest loan. Yeah. Just this gentleman here.
My name's Tim. Wouldn't, if you have investment properties with interest-only loans on them, that would be tax deductible, wouldn't it?
Yeah,
so you
100%.
wouldn't want to pay down your interest-only loans on those, because that's really a deduction that you can make.
Correct. We haven't covered deductions yet, yes, but interest only on your loans is tax deductible. Interest on interest is also tax deductible. And the interest on interest on interest is also tax deductible. No, there are scenarios where you do that, where you're offsetting an offset. So, but yes, it's all tax deductible. As long as what the ATO deems there's a nexus or a link between the expense and the income generating asset, you can have it as a tax deduction. And I'll show you the exact ruling that allows you to claim your deductions for your loans, for your interest-only loans. We'll do that in the property section. It's a very good question. Third row, any questions? Okay, we'll go to the gentleman just here in the blue. I will come back to that section, so we haven't...
Hey, Konrad, it's Andrew. I've got two quick questions, if that's all right, about line of
You're
credits.
greedy. You're greedy.
No, I know. If you're taking out a 200k line of credit as your deposit,
Yes.
is the interest on that deposit then a tax deduction on the investment property?
Yes, it is. Yes. It doesn't matter where the money's coming from. It's as long as there's an expense, there's a link between the expense and the income generating asset, it's tax deductible. One thing I'm going to show you though is you've got to be very careful with this. Let's say you've got an offset, you've got a master facility, you've got a home loan, which let's say you've got an interest-only loan for $400,000, and then you've got a line of credit for $200,000, and this is an investment property. And within that line of credit, you can have multiple splits. You can have a split for 100 and 100. Don't ever use this money to pay for any of your personal expenses or consumables. Don't buy cappuccinos or clothing or anything like that. The moment so every year when you put in your tax returns, what you should do is print off the BSB and account number. You just print off the statement for the whole 12 months. If the ATO sees that you've used some of these funds for personal use, it's an investment expense, they can deem the whole thing non-tax deductible. So do not ever mix your personal expenditure with your lines of credit that you have against property. Because I've seen these, people get these investment properties and they go, I want to buy a boat with this one. And then, you get audited. Let me tell you, you'll be in trouble. Now, I've been audited about I'm actually... I get audited all the time. My advice is this: make sure you get audit insurance. I've got audit insurance which costs me $2,500 per year. I get 150 grand with my solicitor and I get 100,000 with my accountant. Now, what actually happened to me is I set up a number of company structures, and one of the companies that I set up was a company where its sole purpose was to provide advice to another company that was buying properties. And the directors of the company, which was me and my wife, they had to get educated to provide that advice, right? So being directors, we sent ourselves off to different courses. Some of them were personal development courses like Anthony Robbins, others were actually property courses. When I submitted the tax deduction, it got knocked back by the ATO, saying that it happened at a point too soon to the actual investment. So what I did was I sat down with my wife and we wrote this 45-page document quoting case law from the ATO websites trying to substantiate our deductions. The ATO came back and they said no, and when they come back with a no, they send you this check and they charge you 13.9% interest or something, and they say it's now payable due now, $25,000. So it's always going up, right? So I rang up my accountant and he says, well, look, why don't you just activate your audit insurance? So I wrote to the ATO and I said, look, I want to go to court with this. I've got 250 grand that I can blow on this. Let's go to court. And you know what? If I win, I'm going to go to the papers, I'm going to go everywhere. I'm going to tell all the other investors that they can claim personal development as a tax deduction. A month later, they wrote a letter to me, your deductions have been accepted. I can't tell you how wonderful that feels when I fall under pressure like that. So now every year I just renew my audit insurance and I just write a letter to the ATO. I look forward to my annual audit. I have enclosed my renewal slip for my insurance for $250,000. I just want them to take me, let's go, let's book it in. Because now for them it's a business decision. If they're chasing 25 grand and you're going to spend 250 fighting it and they can potentially spend 30 or 40 in court, they just won't do it. Because the ATO now operates very much like a business. They look at the person. Now the other thing is with deductions, as you grow your property portfolio, what the ATO actually does is they've worked out that every industry or every career that you have has an amount that is acceptable as a deduction. It's a rough estimate. So if you're a plumber, they know you're roughly going to be claiming this amount per year. If you're a doctor, it should be this amount. The moment you go above that, you get referred to a real person. And they go, why is he claiming more than the industry standard or the average? And that's when you start getting flagged and start getting audits, meaning they want more information. Can you substantiate these deductions? So if you are building a large property portfolio, I urge you to get audit insurance because then you don't have to worry about it. It's tax deductible for you. And if anything happens, anything gets challenged, bang, it's done. You can sleep at night. So good question. Now, anyone here in this side of the room? Yep. Did you have a second question?
I was just going to ask with that, talking about the capitalising interest, if you're working just buy and hold very long term, are you not going to do that in that you've got to then pay interest on that for the rest of the life of the loan?
You are paying, yes, you are paying interest for the life of the loan, but remember, your rental's always going up. So even though you took some equity from the future, you've used that 45,000 and 45,000, always think of it as how much you're paying on the loan, how much your property is worth, and the rental yield on the property. Because eventually it's becoming cash flow neutral and positive anyway, the longer you hold onto a property. So just to answer, let me just elaborate on that a little bit more. If you're buying a property, and let's say your cost of funding is 7%, and you start off with a rental of 4%, your rental's going to go up, isn't it? But because you took some equity you've used those 2 lines of credit, for example, or used another 50 or 100 grand, what you've actually done is you've moved this to the side because now it's going to take longer for that property to be cash flow because you've used up more, you've taken more debt onto that property. So the rental has to go up a lot more to cover that debt. But remember, the rental's always going up, so it's always on a diminishing scale. But what you're effectively doing is the reason people don't invest in property, with that example, is that $1,000 a month hurts them, doesn't it? That's 12 grand. So they're thinking, I'm not going to buy another townhouse because it's another $250 a week. We can't afford this $250, and they stop. So if you can solve that by having putting in more deposits and capitalising interest, you're getting over the number one problem with holding property, which is the difference between the 7% in the rental yield, or whatever the mortgage is in the rental yield. And that's what capitalising interest does. But you can't capitalise interest unless you have the psychology where you're comfortable with the interest component. That's the key. So imagine you're not comfortable with interest. I mean, there's no way you're going to do it. So that's the thing. So to answer your question, yes, you have to pay for that high amount. So if your property is worth 450 and you've used one line of credit for 45, which is already built into that, but you've used another one for 45, which means that your debt on that property now is 495. The moment it becomes cash flow neutral, you're always paying interest on that 495, even though you purchased the property at 450. Let's say it costs you another 45, so it's 540. But would that make a difference in 20 years' time when the property's worth $2 million and you've got a 540 interest-only loan? It doesn't make any difference, does it? So you're just taking money from here, dumping it there. That's all you're doing. Does that answer the question? Yep. Great.
It's just negating the negative gearing.
We haven't covered negative gearing yet. We'll cover after lunch. So I haven't covered that yet. I'll cover that in detail.
Hey Konrad, my name's Cameron. Just what you're talking about before about buying an investment property in a different entity each time.
Yes.
We're sort of having trouble getting loans in those trusts that have just been set up.
Yes.
And they're asking for us to go personal guarantor or guarantee,
which defeats the purpose of having the structures in the first place.
So how do you sort of get around that?
It's very difficult. Now, what we teach people to do is this. Let's say you're the individual, and you've got a proprietary limited company. Now, by the way, I'm not an accountant, so I'm just giving you hypotheticals here. I shouldn't be actually showing this example. You've got a trust here, and you've got beneficiaries. You've got directors in the trust. Now, what actually happens is the loan is actually in your own name, and then you lend the money back to the trust. So your loan is for $500,000. You lend the money back to the trust, which is through the company as the trustee for the family trust. And the trust pays you back the loan repayments at commercial rates, which is usually 1% or 2% above standard variable rate. The property actually settles in the trust. Okay? Now, because it's a separate legal entity, what actually happens is because the income is derived from the trust, you can offset non-cash deductions and cash deductions against the income derived in the trust, which will cover negative gearing later on. And the only thing you can claim against your personal income is the interest-only expense on the loan, or the difference between the loan and what you're getting back. Now what's happened is the ATO has challenged this wrongly, and Warren Black is actually appealing it. This is a very good structure here, because what you're effectively doing is you don't own the property, but you're claiming roughly the same amount of expenses as if you did. So you have control but no ownership, which is great. So you get sued, you have nothing, right? Now we've modified that whereby you can gift the actual loan to the trust, but you can't claim any negative gearing benefits until the property is cash flow positive, and it's going to be offset against the income of the property, right? To answer your question, there's only 3 banks that allow to do. We had so many problems with this structure, we had to get on the phone and actually educate the banks on what the hell we're talking about. Because they didn't like the fact that just before settlement, there was another loan between the individual and the trust. And they don't understand why is there another loan? So the only banks that we could do this with was CBA, Bankwest, and St. George so far. Now they've even become tighter because the credit policies are getting harder and harder. So they're even knocking back some clients, or if they're not, they're only allowing 80% LVR. So to answer your question is, we have no influence over banking credit policies. You might have to just buy the first few in your own name, and then negotiate with them to have this structure in place for future purchases. Does it leave you exposed? Absolutely. What you can do also is this. Sometimes your number one asset protection is not actually the trust, it's actually using debt. And I'll give you an example. Let's say you've got a property worth $450,000 and you've got a loan against that property for, let's say, $400,000. What you can do is you can go to a family member and you can actually get them to register a second mortgage against that property, let's say for another $500,000. But when they register the mortgage, they sign a discharge mortgage letter saying the mortgage has been paid out with no date on it. and they give that to you for safekeeping. So if anyone sues you, you've got the first mortgage with say NAB for 400,000, and then Uncle Bill has another mortgage for 500,000 against that property. Remember, when you get sued, all these structures are in place in the event that you get sued. Okay, when you get sued, the solicitor does a title search and says, what does this person actually own? And they say, okay, he owns a townhouse with 450. The second question is, are there any registered or secured creditors against that property? Yes, there are. There are two. It's NAB, 450 or 400, and there's another person which has a second registered interest for 500. The asset's worth 450. You've got here 900,000 worth of debt. If they send you into bankruptcy, who gets paid out first? Secured or unsecured creditors? Secured, right? So would they pursue that person? They'll say to the client, listen, he's got nothing. So yes, we can pursue him in court. Just park 100 grand into my trust account. We'll see what happens. Because when solicitors sue someone, the number one thing they look for is, can we get any legal fees out of this deal? And then after our legal fees, would there be any money left for the client? That's what they do. So to answer your original question is, you can use other structures to do asset protection, even though it's in your own name. And I would suggest you just speak to 21st century accounting. But yes, it's getting more and more difficult to use this asset protection structure in the current environment. Absolutely.
But will that come back? Like
I think it
low
will
doc
potentially, but it's going to take a few years.
Yeah.
I think it will.
Thanks.
Anyone else in that side? Okay, just one more there. We're going over time with just a little bit, and then we'll go back to that side of the room.
Hi, my name is Tim. I just, with your interest-only loans, Sasha last night was talking about insurance and getting debt cleared. If I have insurance for debt clearance and I have an interest-only loan and die, what happens with the principal?
It gets paid out. So, and this is the thing, I mean, this is the way I'm structured, that even the owner-occupied property is in the bloodline trust. And the bloodline trust basically has no vesting date, it runs indefinitely. What I recommend you do, and I'll cover this after lunch, is always match your death cover to the amount of interest-only loans that you have. So if you've got $6 million worth of interest loans, you should have death cover worth $6 million. When you die, all your debts get paid out, and the beneficiaries get all your properties unencumbered. The worst thing you can do is spend 30 years paying off the principal of something. That's the dumbest thing you can do. It's such a waste of life. Get the insurance companies to do it for you. Does everyone agree that we're all going to die one day? Yes? Does anyone think they're not going to die? Nigel. So if you've got insurance, you've got death cover, why would you spend your life paying off a principal of something where you can just match your death cover to the debts, you die, everything gets paid out, and you've had a great life and you've accumulated a bunch of assets, and now your kids are beneficiaries. Your beneficiaries can be anyone, can be a charity, could be anyone. Get everything unencumbered. To me, that's an effective use of your time. So very, very good question. Just this side of the room, we're going to finish off.
Hi, my name's Kathy. I'm from the Sunshine Coast. My question just is, when you were talking about having an offset facility, if you've already got a line of credit, is the offset facility necessary on your principal place?
Yes, because a line of credit is just a line of credit. It doesn't necessarily mean that it's offsetting anything. An offset facility is a number of things. It's a line of credit, plus it's a credit card. It's automatic, and it's automatically getting paid out at the end of the 55-day interest free. Can you set it up manually? Absolutely. But to me, you can just set it up so it's all autopilot. So to answer your question is, a line of credit might not have an offset facility unless you create one. So if you've got a line of credit, if you've got a property here for $450 and you've got a $100,000 line of credit just sitting there, your pay doesn't necessarily have to go into that line of credit.
Does. If it's already set up to do it?
If it's set up, then you've got an offset of some type, yes.
Okay.
But a line of credit is just a line of credit. It's just an available amount of equity that you can draw out at any time at interest-only terms. That's all a line of credit is.
Oh, okay. So we've got the credit card attached and all that sort
then
of
it's
stuff.
already done.
Okay.
So you've already got one, yes. Yep, and the gentleman at the back, just in the middle. Why don't you take a couple more, because we are running 5 minutes behind schedule.
Hi, Konrad. My name is Niladri. Is it possible for an owner-occupied property to have interest-only loans with an offset account?
Absolutely, yes. Owner occupied, you can have interest only, absolutely, with an offset facility, yes.
Brad, my name's John. Just a question with reference to your structuring of the your while back there in your presentation. You said to link to your first investment property with your own occupied home.
Yes.
Are you actually cross-securitising there,
No.
the structure?
No, cross-securitization is only when in the mortgage document there's a deed of charge that secures one loan with two assets. They can be standalone. They don't need to be cross-securitized.
So you can still have the one loan facility, but not cross-securitise?
Correct. Yeah. So you can have multiple properties with one lender, not cross-securitized. Cross-securitization is actually in the mortgage document. Now, sometimes they don't actually tell you about it. You might have it, you're not probably aware of it until you try to do something. But you can have multiple properties with one lender where they're not cross-securitized. They're standalone properties with individual lines of credit, meaning you've got control over them. You can sell this one, you can refinance this one. How do you find out? It's in your mortgage document, and you can ring your bank and find out. Absolutely, yes. Okay, so it's now close to 1:10. We're going to head out for lunch for an hour. And we'll be back at 2:10 on time. And I'm going to start off with a bit of psychology and then go straight into property. Thank you very much.